This is part 2 of the presentation for Chapter 21, Accounting for Leases. In this part of the presentation, we will cover operating leases as well as some special topics concerning leases and presentation and disclosure. In this learning objective, we will study the accounting for operating leases by both lessees and lessors. We discussed the 5 tests for a lease to be classified as a finance lease, including transfer of ownership, bargain purchase option, lease term, present value, and alternative use. A lease only has to meet one of these 5 to be classified as a finance lease. But if the lease does not meet any of the 5, then it will be classified as an operating lease. As part of the new leasing standard, all long-term leases, regardless of whether they are classified as finance or operating, will be required to have the recording of a right-of-use asset and lease liability by the lessees. However, the difference in the two types of leases is in the amortization of the right-of-use asset, which will, for operating leases, be done in a manner that will allow the recording of one lease expense that is the same amount for each period of the lease term. To illustrate the accounting for an operating lease by the lessee, we will study the lease of a standard cardboard compactor that is not specialized by Trailer Stores from Joss Way Disposal, Inc. The non-cancelable lease is signed on January 1st, 2020 and is for 3 years. The compactor has a cost and fair value at the commencement of the lease of $60,000, estimated economic life of 5 years, and an unguaranteed residual value of $12,000. The lease contains no renewal options, and the compactor reverts to Joss Way at the end of the lease. The implicit rate used by Joss Way is 6% and is known by Trailer. Joss Way, the lessor, determines the lease payment so that it can earn a rate of return of 6% per year. They begin with the fair market value of $60,000 and subtract the present value of the residual value of $12,000, which is $10,075.44, based on 3 years and 6% interest. The amount to be recovered by the lease is $49,924.56. The 3 payments of $17,620.08 are determined by dividing the $49,924.56 by the present value factor of 2.83339 for an annuity due for 3 periods at 6%. After applying the 5 tests for a finance lease, we see that none of the 5 were met. There is no transfer of ownership at the end of the lease, nor a bargain purchase option. The lease term, 3 years, is 60% of the economic life, 5 years, of the compactor, so less than 75%. The present value of the 3 lease payments is $49,924.56, which is only 83.2% of the fair market value of the compactor, $60,000, at the commencement of the lease, so less than 90%. Notice that the present value of the unguaranteed residual value of $12,000 is not included in the present value test. This is different from the illustration we looked at in the first presentation for the backhoe and is important. Unguaranteed residual values are not included in the present value test, and many times this can make a difference in whether or not the present value test is met. The alternative use test was also not met because the compactor is not specialized and will have value when returned to Joss Way at the end of the lease term. Thus, this lease will be classified as an operating lease by Trailer, the lessee, and by Joss Way, the lessor. Trailer would record the lease by debiting right-of-use asset and crediting lease liability for $49,924.56, the present value of the 3 lease payments. Since this is an annuity due, The first lease payment of $17,620.08 will all be debited to the lease liability and cash would be credited. This is the lease amortization schedule for trailer. This is an annuity due, so the first lease payment will be debited entirely to the lease liability. This schedule shows the amount of interest that will be included in the recording of the lease expense that we will see in the next slide. As with previous amortization schedules, there may be rounding, so the last interest expense should be an amount to make the lease liability zero at the end of the lease. Now we have a new schedule that looks similar to the amortization schedule, but this is actually the lease expense schedule. As we stated earlier, operating leases differ from finance leases in that there is a single lease expense recorded each year that is equal. When we recorded finance leases in the first presentation, we had two separate entries, one for interest expense and another one for amortization of the right-of-use asset. The amortization of the right-of-use asset was totally separate from the recording of the interest expense and was done by straight line. Now we are going to determine the right-of-use amortization based on the amount that is needed to keep the lease expense the same for each year. So for the first year, we take the annual lease payment of $17,620.08 and subtract the interest that was calculated in the prior amortization schedule of $1,938.27 to determine the amortization of the right-of-use asset of $15,681.81. We will make the same calculation in the second year by subtracting the interest of $997.41 from the lease payment to get $16,622.67 for amortization. In the last year, the entire lease expense will all be for amortization of the right-of-use asset because the last payment will have been made on January 1st, 2022. To record the lease expense for 2020, we debit lease expense for $17,620.08 and credit the right-of-use asset for the amortization amount of $15,681.81 and credit lease liability for the interest portion of $1,938.27 per the lease expense schedule. On January 1st, 2021, we make the second lease payment of $17,620.08 and debit lease liability and credit cash for this amount. For the second year, 2021, we would make a similar entry to debit lease expense for $17,620.08 and credit the right-of-use asset for amortization of $16,622.67 and credit lease liability for interest of $997.41. And we make the final lease payment on January 1st, 2022 and debit lease liability and credit cash for $17,620.08. The final lease expense will be debited for $17,620.08 and this entire amount will be credited to the right-of-use asset for amortization. Now both the lease liability and the right-of-use asset are no longer on the books of trailer. At the end of the lease, the cardboard compactor would be returned to Josway per the lease agreement. We will use the same information to illustrate the accounting for the operating lease on the books of Josway that we use for trailer as shown on this slide. The same classification test would be used and the lease would be classified as an operating lease. Josway would not remove the asset from their books but would continue to report it as an asset and record lease revenue. They would depreciate the compactor according to their depreciation policies, which in this case is double declining balance. When the lease is signed, Josway would receive the first lease payment. Since the compactor has not been available for use by trailer, Josway would debit cash but credit unearned lease revenue for the $17,620.08, and they would do this each time that they received the cash. At the end of each of the 3 years, Josway would debit unearned lease revenue and credit lease revenue to recognize that amount. Josway would also record depreciation expense for the compactor by debiting depreciation expense and crediting accumulated depreciation equipment for $24,000. This is equal to 40% of the $60,000. The 40% is 2 times the straight line rate of 20% for equipment with a 5-year life. This is according to the double declining balance method. Josway would also record other costs associated with the equipment, such as insurance, maintenance, and property taxes. In this learning objective, we will discuss the accounting for some of the special features of lease arrangements. Special problems that are associated with leases include guaranteed and unguaranteed residual values, which we discussed some in the first presentation and will discuss in more detail in this one. And we will also discuss some other types of lease adjustments such as executory costs, prepayments, incentives, and initial direct cost. We will revisit bargain purchase options briefly and discuss leases that are shorter than 1 year. We will end with presentation, disclosure, and analysis. If you remember from the first presentation, the lease stipulated that Sterling guaranteed that the backhoe would be worth $5,000 at the end of the lease term. However, because they believed that the backhoe would be worth at least that much, they were not required to include the $5,000 in the lease liability. This is the rule for lessees and guaranteed residual values. Lessees are only required to include in the lease liability any guaranteed residual values that they believe they will actually owe to the lessor at the end of the lease term. They do not, of course, include any unguaranteed residual amounts in the lease liability. So now let's say that Sterling did not think that the backhoe would be worth the full $5,000 when they return it to Caterpillar, but instead believe it will only be worth $3,000. Then Sterling would be required to include the present value of the difference of $2,000 in both the lease liability and the right of use asset. The present value of the $2,000 for 5 years at 4% is $1,643.86. Sterling would add this amount to the present value of the 5 rental payments of $95,890.35 to get a total of $97,534.21 for the right of use asset and the lease liability. This is the amortization table for Sterling that includes the $2,000 of the guaranteed residual value that Sterling believes that it will owe to Caterpillar at the termination of the lease. This does change the amortization table to include not only the 5 $20,711.11 annual rental payments, but also the $2,000 anticipated amount of the guaranteed residual value. To record the signing of the lease, Sterling would debit right of use asset and credit lease liability for the $97,534.21 and also record the first lease payment by debiting lease liability and crediting cash for $20,711.11. This slide shows the entries that would be made by Sterling with and without the $2,000 owed on the guaranteed residual value. The interest and amortization amounts are higher when the $2,000 is included because of the additional payment that will have to be made at the end of the lease. However, the lease payments are still the same. Now, let's say the backhoe was only worth $2,000 at the end of the lease instead of the $3,000 that Sterling anticipated that it would be worth at the beginning of the lease. Sterling would debit the lease liability for the $2,000 that it included, but would also debit loss on lease for the additional $1,000 that it owed Caterpillar and would credit cash for the total paid of $3,000. As we stated before, a lessee would not include any unguaranteed residual value in the lease liability or right of use asset because they would not owe anything to the lessor at the end of the lease term, regardless of what the item was worth. So thinking about the example of the operating lease where trailer leased the cardboard compactor, if you remember, they did not include any of the unguaranteed residual value of $12,000 in the recording of the right of use asset or the lease liability. Referring back to the finance sales type lease involving Sterling and Caterpillar, Sterling had guaranteed the $5,000 residual value of the backhoe. However, the computation of the payments due from Sterling would have been the same even if the residual value had not been guaranteed. The lessor will always subtract the present value of either a guaranteed or unguaranteed residual value from the fair market value to determine the amount to be recovered from the lessee. However, there is a difference in the recording of the sales and cost of goods sold amounts when there is an unguaranteed residual value. The lessor will reduce both the sales revenue and the cost of goods sold for the present value of an unguaranteed residual value. The reason that the present value of the unguaranteed residual value is subtracted is because the lessor cannot be sure that this amount will be recovered when the item is returned. They do not have to do this, though, when there is a guaranteed residual value because the lessor knows that if the item is not worth the residual value when it is returned, they will be compensated for the difference by the lessee. However, the gross profit is not affected by whether the residual value is guaranteed or not, which we will see in the next example. Now we're going to look at the difference in the recording of the sales and cost of goods sold for the Sterling Caterpillar example when there is a guaranteed and an unguaranteed residual value to see the difference. Just to refresh your memory, the sales price of the backhoe was $100,000. The present value of the $5,000 residual value was $4,109.65, and the cost of the backhoe was $85,000. This slide shows that with an unguaranteed residual value, the sales revenue reported would only be $95,890.35 and cost of goods sold would be $80,890.35. The difference between these amounts and those reported for a guaranteed residual value is the present value of the $5,000 or the $4,109.65. Notice, though, that there is no difference in the gross profit on the sale under either method. It is still $15,000 as we mentioned earlier. The gross profit on a sale is not affected by whether the residual value is guaranteed or not. This slide shows the entries for Caterpillar with the guaranteed and unguaranteed residual value. We can see in the beginning the differences in the sales revenue and cost of goods sold entries that we discussed in the previous slide. Also, if you notice at the end of the lease, if the backhoe is returned with only a value of $3,000 instead of $5,000 and the residual value is guaranteed, then Caterpillar will receive $2,000 in cash from Sterling. However, if the residual value is unguaranteed, then Caterpillar has to record a loss for the $2,000. Otherwise, there is no difference in the entries. Just to recap the information on guaranteed and unguaranteed residual values, let's look at this chart. You ignore unguaranteed residual values in the classification test and the recording of the lease liability by the lessee. Only the lessor includes the unguaranteed residual value in their lease receivable. On the other hand, a guaranteed residual value will be included in the classification test by both the lessor and lessee and in the computation of the lease receivable by the lessor. A guaranteed residual value may be ignored by the lessee in the computation of the lease liability and right of use asset to the extent that the lessee believes the leased item will at least be worth the guarantee amount at the termination of the lease. Any amount less than the residual value that the lessee determines should be included in both of them. Now we will discuss another item that should be considered in determining the lease liability, and that is executory cost. Executory costs are the normal expenses that are associated with owning a leased asset, such as property insurance and taxes. Sometimes these amounts will be included in the fixed lease payments made to the lessor. If they are, then they should be included in the lease liability. If the payments instead are made directly to the taxing authority or the insurance providers, then they are considered to be variable payments and are expensed as incurred. Sometimes leases will require prepayments by the lessee, such as the last month's rent in advance, or there may be some type of incentive paid by the lessor to get the lessee to lease. In both of these cases, the right of use asset will be affected. Right of use assets should be increased for the amount of any prepayments made by the lessee to the lessor, and reduced for any lease incentive payments made by the lessor to the lessee. Also, any initial direct costs made by the lessee will increase the right of use asset, and we will discuss those next. This table contains costs that would be considered to be initial direct cost and those that would not. It is important to note that the initial direct cost included are those that would not have been incurred had the lease not been executed. Those that are excluded are costs that would have been incurred regardless of the lease execution. As we stated previously, initial direct costs by the lessee will be included in the right of use asset, but not in the lease liability. The lessor will account for their initial direct costs depending on the type of lease. For an operating lease, the lessor will defer the cost and amortize them over the life of the lease. If it's a sales type lease, they will recognize them in the same period as they recognize the profit on the sale. So these are both in accordance with the matching principle. We discuss bargain purchase options when we discuss the lease classification test. Bargain purchase options should also be included in the present value of the lease payments. They will also affect the amortization period of the right of use asset. When there is a transfer of ownership or a bargain purchase option, the right of use asset will be amortized over the economic life of the asset rather than just the lease term. As we also discussed previously, the FASB decided that all long-term leases that were over 1 year would be capitalized. However, short-term leases that are 12 months or less will not be required to be capitalized. The lessee would just record rental expense as incurred. However, it is important not to forget that renewal or termination options like bargain renewal periods are included in the lease term test if they are reasonably expected to be exercised by the lessee. This slide gives a summary of the presentation of finance and operating lease assets and liabilities on the balance sheet and the interest, amortization, and lease expenses for the lessee. For both finance and operating leases, the lessee will report a right of use asset and lease liability. For a finance lease, the lessee will report both interest and amortization expenses on the income statement. However, for an operating lease, they will only report lease expense. This slide shows the presentation for the lessor for a sales type and operating lease. For the balance sheet, the lessor will remove the leased asset and set up a lease receivable. For an operating lease, they will just continue to report the leased asset on their balance sheet. For a sales type lease, the lessor will report the selling profit or loss as well as the interest revenue on the income statement. For an operating lease, they will report the lease revenue normally on a straight line basis and depreciate the leased asset as they normally would. Both lessees and lessors should report the nature of the leases they have as well as how any variable lease payments are determined. They should disclose the existence and terms for options to extend or terminate the lease. There should also be disclosure about the residual value guarantees. Any significant assumptions made, such as the discount rates for present value calculations and judgments, will need to be disclosed. Lessees will have quantitative information that should be disclosed, such as total lease cost, financial lease costs segregated between amortization and interest costs. They also need to disclose their operating and short-term lease costs, and a weighted average remaining lease terms and discount rates, as well as a maturity analysis of finance and operating lease liabilities for the next 5 years, along with the sum of the undiscounted cash flows for years after that. Lessors should report lease-related income and income from variable lease payments that are not included in the lease receivable. They should disclose the components of the net investment in both sales-type leases and direct financing leases, which we will discuss in the next presentation. A maturity analysis for operating lease payments and a separate maturity analysis for lease receivables are required. They should also discuss how management handles the risk associated with the residual values of leased assets, including those with third-party insurers. There will be changes in many ratios calculated based on the changes in the accounting for leases as shown on this slide. Return on assets will decrease as more assets are shown on the balance sheet. Earnings before interest, taxes, depreciation, and amortization will change as companies amortize the additional right-of-use assets. Debt-to-equity ratios will increase, and interest coverage ratios will decrease as more liabilities are brought onto the balance sheet. This is the end of the second part of the presentation for Chapter 21, Accounting for Leases.